Joining us now, Sarat Sethi, DCLA managing partner and portfolio manager. He's also a CNBC contributor. December is usually a great month. Didn't start out so great.
It did not, and you had a few things going on. I mean, obviously last week with a little tantrum going on in the markets, but you've also had a bifurcation of the markets. If you look beneath the surface, the equal weighted indexes are all down. And so you're still being driven by the Fab 7, Fab 10. The generals are leading, and the rest of them are being left behind. It was a similar thing happened early in the year and last year.
The 10 straight days down for the Dow, not the same for the Nasdaq. I think the Nasdaq was actually at that point was up, but then it lost on Thursday.
On Thursday, and that's part of what I was saying, because the Dow was, United Health is part of the Dow, so that was down 20%, and that was a big weight of the Dow. But all the other indexes were down, Nasdaq being ridden by the Googles of the world, the Teslas of the world, et cetera. So that's where the money's going at the end of the year. The momentum investing is still back. However, the other side of it, if you're kind of a longer-term investor, I would look at stocks that are completely out of favor, that are being sold, A, because they're not momentum, and B, because of tax lot selling. So, for example, a Freeport-McMoRan. It's down 12% in 3 months. It's flat or down for the year. Copper demand is through the roof. It's whether you think EVs are going up, whether you think of data centers and new homes and new buildings. Copper is everywhere. We haven't built a copper plant in the world in 10 years.
It's an EV plant? You've liked Freeport for a while.
I have.
You haven't made any money.
Well, it was up to 52, and now it's back to 38. So, you did make money mid-year, but I have liked it for a while. It's a great cash flow machine. Not a lot of competition in there, and really not more for EV, but if you look at data centers and inputs of where copper goes, and it's just an expanding global play.
When's the last time we had a 10% pullback?
August. First week of August was when you had a real, but it was literally for a week, Joe. And it was so quick, so fast, most people don't even remember.
So I don't. So 2 or 3 years, we've had very few corrections.
Yeah, and historically, every 18 months, you get a 10% correction. Are we primed for one? Absolutely.
Well, that's what I thought was starting when we had 10 straight down days. The first time that's happened since 1974. But then Friday looked like it wanted to dispel those notions immediately that there was anything serious.
Well, yeah, Friday started to come back a little bit after we had the 3.5% down day. I don't think we're out of the woods in terms of where we are with volatility, especially as we get into the inauguration. And you get into next quarter and people start talking about where earnings are going to be and where the real growth is going to be in earnings. And then, interest rates came back into the picture. The view was, hey, we'll have a couple of cuts next year. Right now, people aren't too sure, and that has a big play on valuation.
Do you think the labor market and the overall economy is showing signs of weakness?
I think you're definitely seeing signs of slowing down, but I don't think it's to the point where we're going to call a recession. It's just going to be, hey, things aren't going to be as great as they were before. But labor market's still strong. Demand is still strong. The consumer is still strong. You're seeing travel. You're seeing people spend money going out. If you look at all the data points as we follow airlines, they're still full. They're fully booked. Pricing hasn't come down. Oil prices have come down, which is a good input. And demand for labor is there. The question will be, what happens the next couple of quarters?
Well, are you more worried about the economy showing signs of moderation or inflation still being, we haven't put a stake in it yet?
More worried about inflation.
You are.
I am.
But you're worried about both.
No, I'm not as worried about.
You're not worried about the economy.
No, I think
so. Then we shouldn't be cutting.
Unless inflation is not going to come back to 2%.
It's not going to.
All right. So I think the Fed is kind of holding back to see where we're
Could it come back? What would cause it to come back with labor strong?
Well, I think what would cause it to come back to 2% might be a slowing economy where demand just goes off the roof. Historically, interest rates have not been this low for the last 15 years. So that's the question. What is the normal rate of interest? And what happens if and when China starts growing again? What does that do to the underlying plays of, whether it's the copper plays or energy plays or all the things that are coming down that are bringing inflation down? But I do think labor it's not that bad. It's not that bad a thing if labor prices are rising, because remember, 70% of our economy, and which is what we like to be invested here in the U.S., is the consumer. And if the consumer has money in their pocket, they will spend it. You'll get the multiplier.
Well, if inflation stays near 3%, what's the Fed going to do?
I don't think the Fed will cut anymore, or if they do, it'll be very small. But that's not a bad thing. If we know the uncertainty,
you're okay at 3%
I
inflation?
think 2.5% to 3%, the economy can handle it just fine, because the 10-year will be between 4.5% and 5%. If that's where you kind of have to look to see where is capital cost for corporations. Is it going to be something that they can expect? Joe, if you take that uncertainty out and you say, hey, we know kind of what band interest rates are going to be in, consumers, corporations, they will know how to then look for the future.
It helps with our debt, obviously, and the repayment, but it doesn't help because of people that are living, at 3% is a lot worse than 2% if you do it over time. 5-6 years compound that. The dollar's worth much less than your purchasing power.
Absolutely. But then also you have to then put money to work in capital, and you also then have to look.
Not everybody can do that, though.
I don't disagree with you. But then at least interest rate's not zero for them either. So you can get 4, 5 to 6% bonds, which you and I know longer term are not the best thing. But at least you're getting better than 0 to 2%, which when it was really destructive.